financial assets over the last 20, 30, 40 years have gone down vis-a-vis gold. And you can print money, and you say about the market going down. Well, what can happen is that the stock market crashes, but it goes up in nominal terms. It's possible that, in nominal terms, you go, say, from 40,000 to 80,000. But the gold price goes up 5 times, or the currency collapses. But as I said, all currencies are bad. All paper monies are bad. If you ask me, Mark, I don't feel comfortable in US dollars. What should I own?
Financial assets over recent decades have systematically lost purchasing power when measured against real hard assets like gold. Continuous paper money expansion masks true economic decline, leaving investors dangerously exposed to severe fiat currency devaluation. Marc Faber, a renowned Swiss investor and economic historian, warns that while stock markets may double in nominal terms, real wealth will severely shrink as gold prices surge fivefold alongside collapsing paper currencies. He predicts a major capital rotation away from overvalued U.S. equities and Magnificent Seven tech stocks towards significantly cheaper emerging markets across Asia and Europe. Driven by favorable demographic trends, developing nations will easily outperform Western economies provided global peace is maintained. Ultimately, holding physical precious metals like gold, silver, and platinum offers the most reliable hedge against relentless central bank money printing and wealth erosion. Now, we present the clips from Marc Faber's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
It's very difficult to measure anything nowadays when money printing is on. But one thing I can tell you, let's say if I measure your salary in gold terms, I can say with confidence that your salary has gone down in the last 20 years. Because I remember I wrote the book, Tomorrow's Gold, Asia's Age of Discovery. And the book was published in 2001. And I foresaw the rise of Asia relative to the rest of the world and so forth and so on. But I also talked about gold and its importance. But in 1999, you could still buy gold at $253. And since then, gold has gone to, as you know, over 4,000. And the S&P has also gone up a lot, and with dividends in some cases. If you were fortunate, maybe you made more money in stocks than in gold. But in general, financial assets over the last 20, 30, 40 years have gone down vis-a-vis gold. And you can print money, and you say about the market going down. Well, what can happen is that the stock market crashes, but it goes up in nominal terms. It's possible that, in nominal terms, you go, say, from 40,000 to 80,000. But the gold price goes up 5 times, or the currency collapses. But as I said, all currencies are bad. All paper monies are bad. If you ask me, Mark, I don't feel comfortable in US dollars. What should I own? I said, I don't see that the Swiss francs would be a better option. I don't see the Brazilian real to be a better option. And I don't think that the Venezuelan bolivar is very desirable and so forth. So maybe the dollar is still the best option. But a better option, the young people, the Generation Z, they will say you should own Bitcoins. Maybe. But I feel more comfortable to own silver and gold and platinum. If there was a recession in the US, and if there was a financial collapse in the US, that it would drag down other markets. But last year, the US market grossly underperformed. For the first time since 2009, it underperformed emerging markets and Europe. So I could argue, yes, you're right. the money could flow out of the Mag 7 stocks in America, of the semiconductors as well, and move into emerging economies, or move into China, or move into India, or move into Europe, because these markets are all much cheaper than the US. If you measure the market by price to sales, price to book, price to earnings, and so forth, all markets in the world are essentially much cheaper than the US.
So rotation out of Mag 7, NASDAQ, or US equities in general into the rest of the world.
Correct. I live in Asia and I see what is happening in the world. Of course, what I don't know, and you also don't know, and nobody knows, is it possible that we are entering World War III? I studied his war cycles as well, and I'm very interested in the war cycles. The conditions are very good for war. But let's say we have peace in the world, then I think emerging economies are going to be doing much better than the developed world. That is my belief, because the demographics are still rather favorable. And we have societies, when something goes bad, people are used to tighten their belts, because we have in many Asian societies or emerging economies practically no social security. So when things go bad, you have to hustle and tighten your belt and take your own initiative. And in Western society, the problem is that people have become comfortable, because we had, I would say, when I look at my life, I was fortunate to be born in 46 after the war. And since then, I benefited from an economic expansion in the world, from rising asset prices, from having been lucky and chosen to go into Wall Street in 1970. And so the conditions for wealth accumulations were very favorable. Those were the conditions for freedom. And nowadays, I think these conditions are no longer there, because when I started to work, the salary level in general was high and asset prices were low. Say, if I measure the Dow Jones, the market cap as a percent of the economy, asset prices were low and salaries high. And now salaries are relatively low and asset prices sky high. So we have an affordability issue that, as you pointed out, Trump realizes. We can measure how people allocate money to what. They have an exposure to stocks or to gold and so forth. We can measure that. At the present time, the allocation to bonds is tiny. People don't own bonds. And of course, sovereign funds and insurance companies and banks and so forth, they own bonds. But by and large, if you go to a room today and you tell people you should buy bonds, most people would think that you're mad, especially with Trump, who is a big money spender. Anyway, my view is that the economy will be bad and very bad, and the sentiment about bonds is like the sentiment about oil is very negative. So just based on sentiment figures, we could have a rally. And I told you, I believe in diversification. I have gold and I have stocks and I have real estate and I have some bonds and cash.
Systemic monetary expansion creates volatile pricing distortions across isolated sectors rather than uniform price gains. While everyday consumer goods surge at retail counters, commercial property values have collapsed by up to 80% despite continuous liquidity injections. Central banks are rapidly losing control over long-term treasury yields, making short-term rate adjustments far less effective. Attempts to push interest rates down toward 1% will accelerate inflation aggressively rather than stabilize markets. A decisive breakout in interest rates is imminent this year, creating major headwinds that equity markets will struggle to absorb. Underneath official GDP metrics, Western economies are contracting for the vast majority of citizens struggling with elevated living costs. Maintaining real, tangible assets remains vital as fixed paper yields fail to offset true inflation rates. Now, let's get back to the interview.
We had exceptional years post 1980, which was the peak in interest rates. And since 1980, interest rates have been in a downward trend until August 2020. And since then, we have a rising trend in inflation and a rising trend in interest rates and commodity prices. And my view is that asset prices have been badly inflated over the last 40 years or so. I mean, when you think of the time you were a child and how much things would cost at the time, especially education and insurance premiums and so forth, we have to say that there has been a lot of inflation. And in my view, what has changed now is the following. During inflationary times, the problem is that the price level doesn't go up evenly if the price level was going up evenly, nobody would be hurt. But no, the price level goes up very strongly in this sector, and then another day in that sector, or another year in such sector, and so forth. And the way money printing works is it flows first to Wall Street. So Wall Street takes a huge cut, and then some money flows on to the banks and insurance companies and so forth, and some money flows into the real estate market. But it's very irregular. And we've seen, say, in the last 5 years, prices for consumer goods at the supermarket and so forth have gone up a lot. But the prices of commercial properties have collapsed. There are properties that are down 80% despite all the money printing. And so I don't believe that you can rely on money printing forever. And what is happening now, and that has never happened before, the Fed seems, or central banks seem to have lost control about some interest rates. They still control the short-term rates. They can increase the Fed fund rate or decrease the Fed fund rate. But the bond market, the 20 years, the 10 years, the 30 years bond market may not be reacting favorably. In other words, Trump, his dream is to have 1% interest rates by year end 2026. He may achieve that 1%, but I, as a bondholder, I don't want that. I want tight money so that bonds and money keeps its purchasing power. At 1% interest rates, my view would be that inflation would accelerate significantly. And then we have to define what is inflation. For most people, when prices go up at the supermarket, that's inflation. But when stocks go up, that's a bull market. And when property prices go up, it's a bull market. It's rather difficult and complex. But my sense is that the bond market, say the last 3 years, the bond market has been kind of moving sideways. In other words, interest rates have neither gone up substantially nor go down substantially, except in some countries like Japan, interest rates are up substantially, percentage-wise. They're still very low, but percentage-wise. And in my view, this year, we'll get a big breakout of interest rates, either up or down. And the stock market will not like it. Interest rates are not particularly high at the present time. So the 10 years is at roughly 4%. I don't think that the cost of living of people is going up by 4% per annum. I think the cost of living of people around the world is going up by, say, between 6 and 12%. And so the interest rate is not high in real terms. And that is an inflationary environment. And I believe that the only way interest rates would go down significantly is what I believe is happening and will happen even more, is that we are overestimating growth. In other words, I think that the economies, certainly in the Western world, are contracting for the majority of people. Now, if you tell me that someone on Wall Street is making a lot of money, correct. 5% of the population, because they own assets, like myself, I'm an economist and I'm a participant in the financial sector. So I benefit from money printing. But as an economist and social observer and historian, I hate money printing because it destroys societies. We've seen in history many societies flourish, and then for some reason conditions changed. The reaction was always print money, and then the consequence was very negative long term.
The historical era of extraordinary investment returns driven by steadily declining interest rates since 1980 has officially ended, marking a fundamental shift toward structural inflation and rising commodity prices. Decades of artificially inflated asset values have created a severe economic disconnect where stock prices remain sky-high, while real working wages stay deeply depressed. Current geopolitical conditions align closely with historical war cycle patterns, posing significant risks to global economic stability. Extreme negative sentiment surrounding government bonds and crude oil suggests a potential short-term contrarian market rally driven purely by positioning. Nevertheless, long-term economic growth across Western nations is being systematically overestimated while real living standards contract for the majority. Persistent money printing continues to enrich financial intermediaries on Wall Street while destabilizing broader society. With actual living costs escalating by 6 to 8% annually, traditional fixed yields fail to protect purchasing power. Surviving this turbulent regime requires a well-balanced portfolio of physical precious metals, prime real estate, and undervalued international equities. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.